Hello, I'm Debra Brennan Tagg, Managing Partner at Brennan Financial Services. Welcome to the market review for the fourth quarter of 2017, and thank you very much for joining us. We have a whole lot to cover today, so we'll get right to it. The themes for this quarterly review are 1. International markets, 2. No, I don't think we have a correction on the horizon, and 3. It's our evergreen theme, diversification really does matter. One of my clients always reminds me that he wants to know the so what about our market research. So as I take you through the most recent updates on market classes around the world, I'll be explaining the so what of the data. This market summary shows what is called a risk-on trade. We usually have at least one red arrow on this summary, but we have all green arrows this time. Risk-on means that the riskier asset classes, such as stocks, are creating higher returns, and therefore it's worth it for investors to take the higher risk, and they're doing it. The fourth quarter market returns for stocks are above their average quarterly return. They're not anywhere near the records they've set, but we have obviously seen very healthy returns in stocks. By contrast, the global real estate and U.S. and global bond markets were positive, but really just on par with their average quarterly returns. Nothing special there. As investors, we know to look forward and not to look backward. It's the old past performance is no indication of future results. And while that cautionary statement is true now probably more than in recent years, we would also suggest that past performance does not necessarily require that we have a big market correction. I hesitate to say that it's different this time, but the passing of the Tax Cut and Jobs Act at the end of last year had unique timing in that it is designed to extend an economic expansion that is already really a bit long in the tooth. We now have more runway for the economy and the stock market to expand before we would expect to see a true economic recession or a bear market in stocks. World stock market performance is the real story for 2017 and what we expect also for 2018. I spent a lot of time during the election season of 2016 talking to clients one-on-one about my personal opinion that what our economy needed more than anything is really a clear direction and a reason for consumers to be confident. Look at the consumer confidence headlines we are seeing in both the Eurozone and in the US. Couple that with Japan's surge in capital spending, an increase in firming inflation in the US, and we see that there really is cohesive strengthening around the globe. You might think that we would have a negative outlook on increased inflation, or maybe even on the decline in the US dollar. However, inflation is a sign that an economy is growing because it means that consumers are willing to pay more for goods. We've seen subdued inflation since 2008, which has always been a sign that we had some growth, but not robust growth. As for the falling dollar, it's good for our exports, and increased exports can be good for the economy. As we take a longer view on the world stock market over 12 months, we see the same themes persistently making headlines. Confidence up, profits up, unemployment down. Factory activity hits a 13-year high, and even oil hit a 2-year high, signaling that we may finally be in a recovery period there. Around the world, things really are going well, and global trade is accelerating. So it really should come as no surprise that markets around the world are responding positively all at the same time. Before we move on, it's worth noting that an area of concern, certainly for me and probably for other market watchers, is that household debt in the form of auto and credit card debt hit a record level. This does cause me concern, but mostly because families who are overextended in their debt and lost their jobs in 2008 really had a difficult time. However, we're not currently in an employment market that is ripe for layoff, so it is not a primary or current concern for us. When we see how all of this is played out in the actual broad market indices, we see that markets around the world have enjoyed positive returns due to this cohesive global strengthening. Many of these world asset class indices posted returns in the fourth quarter that we would expect to see over a whole year. From the highly volatile emerging market small cap index to the very well-known S&P 500 and Russell 1000 indexes, 2017 simply had impressive gains. Now we'll dive into the markets to see where the returns came from. We've spent quite a bit of time over the course of 2017 talking about how strong the U.S. market has been. What started as the Trump trade has developed into a positive stock market that has surprised most in length, breadth, and consistency. Interestingly, while the stock market has been going up, volatility is also incredibly low. There's an index called the VIX that market watchers like us keep tabs on. The VIX hit record lows in 2017 and had more days trading below 10 in 2017 than we had seen in a decade. This doesn't mean that the stock market has lower risk, but it means that we're not seeing as much concern right now about a big drop in the market. Before we move on to the international markets, I also want to point out that large cap led performance over small cap this quarter and in the 1, 3, and 5-year numbers. But that trend may have reason to change. We believe that the recent tax cut will be a bigger boost to small caps than large caps. Privately held companies tend to be smaller companies. If these companies become C corporations and realize a significantly lower tax rate, they stand to have a surge in profit. We'll have to watch how this unfolds over the next few years. The quarterly numbers for the international developed stocks are healthy, but the real story is in the 1-year number versus the 3, 5, and 10-year numbers. We have been in a cyclical pattern where the U.S. markets have been stronger than the international developed markets, but the past 12 to 18 months is an indication that the long-term cycle may be shifting. China took a surprise lead right out of the gate in the beginning of 2017, setting the stage for a strong performance and also for a more calm tone on the global stage, just as recoveries were beginning in some other major economies around the world. They've also clarified that they intend to be part of the cohesive global growth story, which was a boost of confidence. Europe itself is in the beginning of a cyclical growth cycle, with increased consumer confidence, rising income, and a more stable and supported economy. Consumers in Europe have a lot of pent-up demand, so we're seeing spending pick up now that there is not so much uncertainty about the future of the economy. Even Japan, despite very challenging demographics due to an aging population, has seen unemployment drop and job applications increase. It's interesting, but definitely not surprising, to see that when we take negative interest rates out of the picture when central bankers are clear that they will use policies to support the economy, and when world leaders are clear that the direction is towards growth, that companies and individuals feel more confident to make spending decisions. We continue the international story with the update on emerging market stocks, which was the biggest broad market story of 2017. There are many reasons for this, including the falling dollar and worldwide consumer demand for products made in emerging countries. But we return to the so what question. I've cautioned many times during this report about the high volatility and low long-term performance of emerging market stocks, as evidenced in the 5 and 10-year performance numbers. By example, even with the past year's very strong overperformance, emerging Asia equity valuations are still reasonable, both on a long-term historical basis and relative to other geographies. Does that mean that you should invest in them? Only if it makes sense for you, which means that moderate investors might benefit for a small amount of exposure, but significant exposure to emerging markets should be saved for higher risk, growth-oriented investors. Again, returning to our theme of diversification, real estate has had solid longer-term performance, as we can see in the 5 and 10-year numbers. Reaching back 10 years would put us at the beginning of 2008, so it's clear why the 10-year U.S. REIT numbers are strong. REITs, or real estate investment trusts, still function as an important diversification tool. While we like including real estate in portfolios, REITs did underperform stocks in 2017. The numbers are still weak for commodities for a very long period of time. Commodities eked out a positive return for 2017, but are still negative for 3, 5, and 10 years. We're not commodities traders and don't include commodities specifically in our portfolios, but the data is still very interesting to watch. The biggest focus for us is to watch oil, which is a big economic influence in our home state of Texas, and we're really pleased to finally see the recent recovery in prices due to the drop in supply. As we review fixed income, we see some surprise performance from last year. Market watchers have predicted for years that bonds would lose value when interest rates start to increase. The Fed, in the meantime, has been slowly raising rates, but the broad bond market still has had respectable returns and certainly did in 2017. For the surprise performance, take a look at the long U.S. government bond return for last year. It's difficult to believe that U.S. government bonds can repeat this type of performance in 2018, especially if the Fed continues on its expected path to increase rates 2 to 3 more times this year. But we do believe that the environment is right for corporate bonds and municipal bonds to provide modest single-digit total returns in 2018. Let's revisit the purpose of fixed income or bonds in a portfolio. We use bonds and stocks together in a portfolio to diversify because they tend to react differently to different market forces. We also use bonds in a portfolio to reduce risk because historically, bonds move less in either direction, either up or down. One of the concerns that we have right now is that if bonds do start to behave the way that people have predicted for years, meaning that their returns are lower than we saw this year, then investors may look for ways to try to squeeze a little more performance out of the bonds in their portfolio. That commonly leads to taking more risks. For example, an investor might sell a government bond and then buy a corporate bond. However, a corporate bond does move more in step with the stock market. The investor has then lost diversification and has increased risk just to try to get some higher returns. If the investor's goals are the same, this is probably not a good move for the portfolio. Here is where we really arrive at the so what. We use diversification as a tool in our disciplined investment strategy, which is designed to address the natural shifts in financial markets and the ebb and flow and strength in different sectors. After last year's stock market performance, we see a big dislocation between the portfolios that are 100% stock, seen as the riskiest portfolio, versus 100% treasury bills, seen as the most conservative portfolio. Does this mean that you adjust your portfolio risk based on what we saw last year? No, you know better than that. Your portfolio should always match how much risk you can handle and how much return you need to achieve your life goals with your money. It is notable that even the 25% stock and 75% treasury bill portfolio returned 6.33% last year. That is what a risk-on environment can do for even a moderate to conservative investor. We are a holistic practice with a focus on both financial planning and investment management. We manage diversified portfolios that are designed to address the long-term goals of our clients within the amount of risk they can handle so they can stay invested through up and down market cycles. Thank you for joining us today. If you have any questions, please email us at teamdbt@brennanfinancialservices.com or visit debrabrennantagg.com for more information about how we help our clients to use their money to have the life they want.